Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com. Welcome back to the show, Eric.
Oh, great to be back, Jim. Thanks for having me.
We're watching the price of oil. It went up today. It's still in the $45 a barrel range that it's been in for quite some time. The big news, though, is that oil and gasoline inventories across the U.S. were drawn down significantly last week. Oil down by more than 6 million barrels. Gasoline down by more than 3 million barrels. So apparently we're still using petrochemicals to power our vehicles, and we're doing it a lot.
Yeah, and that doesn't seem to be really impacting the price that much. It's not surprising to see some additional usage right at the end of summer. And so that's not really, not too big of a surprise, and the impact hasn't been that big where the price is concerned. But I'm still looking at the same thing that we've talked about all year, that I had major cycles bottoming in January of 2016, but that I thought it would take, at least a year or two for a full bottom to really trace itself out and get prepared for a new bull market. There's even been a very consistent and very precise 5 to 5.5 month cycle between each of the key lows in crude oil, dating all the way back to late 2013. But the most recent lows came into play in late August of last year, 2015, then late January, early February of this year, and then the more recent lows we saw in early August, and that ushered in more of a 2 to 3 month consolidation phase on my work. But the next phase of that cycle and of several other cycles is the one I'm really watching, and that comes into play in mid-January of next year.
So can we expect falling prices until then?
No, I would not say falling prices consistently between now and then. And that's the thing about the distance between cycle lows, is that as it conveys, that just times subsequent lows. In theory, you could see crude trade sideways until late December and then give a 1 or 2 week spike down into January and then a rebound from there, and that would fulfill another important cycle low, as I emphasize, in theory. So it in and of itself, that indicator doesn't tell you that prices are going to fall all the way into that time frame, and because we're in more of a consolidation phase, that is less likely. I'm looking for more volatility between now and then, and there are some important indicators and other cycles coming into play in the coming weeks that could impact that as well. So I think that it's going to be more volatility, more sideways trading with a downward bias that will finally bottom in January of next year. But I should also emphasize that bottom is more likely to be at or above the previous lows. Just because you're seeing a sequence of lows does not, in and of itself, demand that each of those lows is lower than the previous. When you have a bottoming formation, you actually see a succession of some lower lows, and then you start to see that turn, and you get some higher lows as the bottom is slowly transitioning into a new bull market.
Will prices fall into the 20s?
I don't know about that, and that's going to hinge strongly on what we see over the next probably month and a half, because that is a decisive time frame for me within this particular cycle. So whether we get back into those high 20s or not, the work that I have does not clearly indicate that one way or the other.
What about the price of gold? What's happening with that, and where do you see that in the new year?
Gold, I still am viewing from the perspective of the overall outlook that I've described the last 2 years, and that was that the bear market would culminate in late 2015, and that 2016 would see an initial 3 to 6 month advance, which would be the largest rally in gold since 2011. We saw that earlier this year. I know we were talking in a couple of interviews talking about how I thought that the precious metals would peak in the middle of 2016 and then enter what would be a kind of a second wave pullback, that you had your initial first wave up from an Elliott wave standpoint, then you get an extended consolidation and or pullback, and then you prepare for the real dynamic upswing, which is the third wave, which I'm expecting in 2017 and 2018. So right now that is similarly in a bottoming process, but a more bullish overall formation has been unfolding in gold and silver. I think when we were talking about a month or so ago, I was explaining some of the more intermediate cycles that were driving prices lower into late August. That was when a 1 to 2 month bottom was expected, and gold and silver saw a decent sell-off into that then, and we've since seen a bit of a rebound. There is still a decent chance for a spike below those lows in the fourth quarter of this year. There's certain key resistance levels that need to hold on this rebound if gold and silver are going to see one more dip. But I think it's all part and parcel of a second wave retracement or pullback that is preparing for a much more bullish move in the 12 to 24 month outlook.
Does the outlook for gold depend on what happens to the equity markets?
To some degree, yes, but I think there's going to be other things driving it, and I guess it's one of those things of what's driving what. I do think that the equity markets continue to go through a 1 to 2 year topping process, and I think there are going to be times when you see some sharp sell-offs in the next 12 to 18 months where gold probably surges on a bit of a flight to quality. But I think that there could be other driving forces that are impacting both, that are impacting the equity markets and impacting gold. And one of those is just what I see as a continually developing crisis in Europe, both in banking, in social and geopolitical structure there, and some of the repercussions even of things like the immigrant crisis, that you're just getting more and more momentum towards a a crisis there in the European Union, and as I've described since 2008, 2009, I thought that the 2010s leading into 2018, 2019 would see a steady erosion of European unity, and that would ultimately lead to a different union. That it doesn't mean that it has to decimate the current union, but I thought that there was still a lot of growing pains that needed to happen there, that we would see a crisis with the euro currency, and that all of that would come together and prompt a realignment towards the end of the decade. I still think that is the likely scenario, and even the Brexit vote in late June was just one more affirmation to that overall outlook. So I think that's going to be something that impacts equity markets, that, many of the European indices really topped in mid-2015, and they've been just steadily developing into bear market since then, and I think there's a second shoe to drop there towards the end of this year and into 2017. And I think that that's going to be one of the things that does really benefit gold in the long run. So it's kind of the interplay between all three of them, the Europe and what I still expect as more problems there, global equity markets responding to that, and gold and silver reacting to that.
Well, on the 3rd of next month, Hungary also has a European Union vote. So it almost seems to be the flavor of the year for people to take a look at whether they want to be members of the EU anymore. Yeah,
and I think that is the real true ramification of the Brexit vote. Is, up until then, you had some referendums floated, and at the last minute, the populace kind of pulled back, and they weren't ready to be, in different countries, weren't ready to be the real trailblazers there. But when you get a nation like the UK voting for Brexit, all of a sudden, I think that gives a lot of momentum to the anti-EU crowds, and I think you are going to see a sequence of countries voting for that. Even before Brexit was approved, the numbers that they gave for several countries across Europe as far as pro and anti-union were so close, so right on that 50-50 cusp, that it would just take a little bit more of a shock or other reasons to push the anti-union crowd over the edge there. And I think that that's what you are going to see. And like so many things, the snowball just picks up some momentum. If a country like Hungary then voted for that, well, that would almost exponentially increase the momentum for other nations that are contemplating it. And you just get that momentum picking up steam, and then you get the big bureaucracy that is the EU suddenly having to react to all of that. And I think that's when you get the markets that much more destabilized, and you get markets like gold and silver really benefiting from that. I know that there have been other elections, I think it was in Austria and a couple other places, that showed a very a right-wing bent, for lack of a better term, but more of a nationalistic instead of the broad for the good of the EU type of mentality taking hold more and more, and so you've got that underlying current moving in that direction throughout Europe.
We'll have more with Eric Hadik right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Eric Hadik. Eric, what do you see in the biotech sphere?
You know, to be honest, that is not something that I really put much focus on or specialize in, so I wouldn't even really feel comfortable commenting on that. So sorry to throw a wet blanket on that one, but I wouldn't feel right even trying to comment on that.
Are they then just, part of the equity trying to draw up money to bring in new investments in it? Just like any other sector? I focus on the broader indices and some of the natural resource sectors within the market, but the biotech is not something that I put enough focus on and have done enough analysis on that I could really even comment. Well, I was going to say, too, there isn't much of a history to draw up any cycles on, is there?
No. And, I mean, with something like that, you can often go back and look at the things that evolved into that or were a similar parallel beforehand and see it's kind of a piece together of cycles. But you're right, there's not as much data, which is, another reason why I don't really feel comfortable getting into it too much.
How does the U.S. election cycle affect the markets?
Well, I think more than anything in this one, I think it's the uncertainty surrounding it that is going to have the biggest impact. I think we did discuss several months ago one of the things that I have cited, and that's the movement of the dollar surrounding several of the elections of the last 30, 40 years, and that multi-year highs and lows in the dollar have coincided with the changing of the guard from Republican to Democrat and vice versa. And so it would be interesting to see, particularly since most of my cycles in the dollar are looking for a pretty important top in the first half of 2017. That at least gives me one hint why to expect something different. But there's so much uncertainty and there's so many wild cards, I think, out there that I think the uncertainty is going to be what really hits the markets. And I think as we get closer to November, it's hard to believe that things would settle down or that, suddenly all the surprises and other shocks that have come to light in the months leading up to this, that they would suddenly disappear or dissipate. And so I have to assume that things are just going to intensify as we get closer to the election. And I think you're going to see that reflected particularly in the equity markets. But then I do think that the dollar is going to play into that beginning in 2017.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. You're listening to HowStreet.com radio. You can find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.